There are certainly ways to avoid forced sales of an asset, even when a family's assets are largely illiquid and a large estate tax bill comes due. Depending on each business owner's unique circumstances, borrowing, deferral, and insurance solutions may have significant potential benefits on cash flow and wealth preservation. Borrowing against assets to pay the estate tax can help maintain family ownership of certain assets and benefit the estate. Intrafamily loans are a popular alternative to seeking a loan from a commercial lender. A loan can originate from other family-owned entities. There can be potential advantages when calculating the difference between the state tax owed by the estate and the income tax owed by the entity receiving interest payments on the loan. Using debt to pay estate taxes is subject to debt market conditions and can make lending more or less attractive depending on the current environment. Using a commercial lender can be more challenging when lending standards are tight. Interest rates are a big factor to consider when securing a loan from a commercial lender. Use caution when funding a business transfer with loans. Excessive debt can be a drag on business and affect a company's long-term success. A Section 6166 election allows for a 5-year deferral plan followed by a 10-year installment plan under specific circumstances. This applies only to owners of closely held businesses when the value of the taxpayer's interest exceeds 35% of adjusted gross estate, and only applies to tax attributable to the value of the business. The application process is complex and qualification is not guaranteed. Life insurance offers a tax-free death benefit. Life insurance also offers immediate liquidity to pay the estate tax. Frankly, it can be a much less stressful way to pay the estate tax compared to the paperwork associated with loans or IRS relief and the risk of an asset fire sale or even having a market decline in the asset you were counting on to pay for the estate tax. Consider the following example. Jim and June have a $20 million projected estate tax liability. We recommended a survivorship life insurance policy that will pay a death benefit when the estate taxes are due. Currently, each spouse can use an $18,000 annual gift tax exemption per beneficiary. With 3 beneficiaries, that's $108,000 per year that could be gifted to the trust for the benefit of the beneficiaries. You can see the annual premium, around $89,000, is below the combined allowable gift tax exemption. The couple will establish an irrevocable life insurance trust to own the policies and gift those premiums on an annual basis, paying 0 in gift taxes. The table shows an annual premium for a life insurance policy and death benefit of $20 million to pay the estate tax liability. Life insurance cash accumulation is not subject to ongoing income tax and pays the death benefit tax-free, enhancing the tax equivalent internal rate of return. And because the couple uses in-estate dollars to gift the policy premiums, those assets are not being taxed at the 40% rate. Combined, this can be a very attractive income and estate tax equivalent yield at life expectancy. Each method of paying estate tax comes with limitations, benefits, and drawbacks. You and your advisors need to understand each option to determine the best plan of action for you and your family. We are here to be the trusted insurance advisors for you and for those you care for most. Reach out to Marcum Insurance today to discuss your estate planning goals and the goals of your clients you serve.